What it do, fam? I hope you're doing well and you're holding fast while this vaccination process slugs along. I was talking to a friend of mine the other day who's been sitting on the fence for a few months considering whether or not to start investing, and I wish I'd recorded the conversation because he addressed a bunch of concerns that I think almost everyone goes through at some point at the start of their investing journey. Of the people in my life, I'd say a large majority of them have gotten off on the side of not investing. Others tiptoed off the fence, while others still dove headfirst into AMC during the Great Wall Street Bets meme run. Whatever the case may be for you, today I'm going to try to address what I think are the most important points that we touched on over the course of our conversation, starting with point number 1. You're watching Sekider, and this is Common Uncommon Questions from New Investors Part 1. Why not real estate? Now before we continue, I'd just like to remind you that this channel is meant for general education purposes only and isn't meant to replace the legal or financial advice from a paid professional. No mention of any stock on this site should be taken as financial advice since we don't know you or what your personal financial goals are. So, we would love it if you could help us out, scroll down, hit the like and subscribe buttons, and keep up with the content that we put out every week. Hopefully, eventually, you'll be able to figure out what assets are perfect for you. Now let's get to it. Alright, so the conversation was long as fuck and it went through a number of stages, so I'm gonna talk about the bigger conversation points over the course of the next 3 videos, and if they do well, then I'll follow up with a few more things that we talked about. Naturally, since most people watching this channel are likely to be beginners in investing or not yet in the markets at all, this will focus on the big questions around investing in general. Now, we did talk about saving versus investing, and he agreed that his savings are making him almost nothing at this point. Any growth he gets from his investments are usually from his own contributions, and the fractional percent interest rates don't really cut it. Particularly, if we get hit with inflation in the near future, he might not even be making money overall. I actually talked about this point a long time ago in one of our first videos, so if you want to get into the nitty gritty, feel free to click the box in the top right corner, go back in time, and revisit that debate. I will personally be skipping over that topic in this video because I basically just summarized what we talked about. Instead, I want to move into the more fun investment option to talk about in this episode, real estate. Now there are mad people out there speculating in the real estate market, and this is obvious by the way housing prices have skyrocketed in places from Seoul to Busan to Gwangju, Sasan, or anywhere in the southern half of the peninsula for that matter. He shared this anecdote. A co-worker of his bought a house in Suncheon 3 years ago for 2억 7천만 won, and its price has shot all the way up to almost 5억 in that time. If we just round up to the 500 million point for convenience sake, that would be about an 85% return in 3 years for just shy of 30% per year for an asset that she lived in, ultimately saving her more money on rent. On top of all that, the location that it's in is under rapid development, so prices are expected to rise even more in the coming years. How could this possibly be a worse investment than putting money in stocks? Well, that's not really a point that I'm trying to make. This is one of those things where it's a matter of perspective, really. And on top of that, real estate as an investment may be better for a lot of people, but for me, it's stocks, and here's why. To explain my perspective, I'm gonna hit it from 3 different angles. The first being significantly higher frictional costs. The second being illiquidity and no cash flows without rental income. And the third being more work is required. So let's start with point 1, frictional costs. Frictional costs refer to the unrecoupable expenses added to the market price of a given asset. In stocks, this can mean things like transaction fees or taxes, whereas real estate can include significantly higher fees to real estate agents on both the sale and purchase ends, as well as interest payments on loans, repair costs, and maintenance costs over the course of ownership. Of course, a homeowner could offset these costs by renting out the space, which is a great option to increase cash flows. But any landlord will tell you that renting out a property can become burdensome in the case of a difficult tenant. In any case, when comparing the frictional costs of buying and selling stocks versus real estate, unleveraged common stocks are much more financially and time efficient than purchasing real estate. It's also a lot more straightforward, and you're no longer beholden to your stocks once they're purchased. Plus, when considering the relatively new laws that tax real estate sales profits at an obscene rate if held for too short of a time, the frictional costs of real estate ownership can cut heavily into potential profits that one may receive from the purchase and sale of a property. Worst case scenario for common stocks? You lose all your money if the company goes under, but that's all you end up losing really. Defaulting on a home loan can mess up your cash flows, living situation, and access to credit in the future. Furthermore, nobody knows when the financial bubbles we're in will pop, and it benefits us in no way to pretend that we're not in bubbles right now. Plus, with credit so cheap at the moment and so many people taking out variable rate short-term loans, any substantial changes to the credit market could lead to much larger calamity than just losing 30% value on some stocks that don't functionally contribute to your material existence anyway. If you're buying straight from the unit owner without the use of a real estate agent, then you could save on frictional costs, but you would also have to ensure that you know what you're buying, understand the paperwork involved, and make sure you're not inadvertently breaking any laws. For instance, if a family member has recently inherited a piece of property from their elderly parent who recently died, but has not yet changed the registration of the property to their own name prior to the sale, often done to avoid taxation, then the purchaser requires authorization from all potential beneficiaries saying that they lay no claim to the property before purchase. Is this something that everyone knows? I doubt it, and getting that paperwork done is important to ensuring the legal purchase of a property in such a situation. Technicalities such as this are a good example of why it's safer to use a real estate agent who, unlike in other countries like Canada or the US, are capped at a certain amount of percentage on their commission. Now, whether or not you're buying through a real estate agent or not, opportunity cost in time and energy to get the deal done is many times greater than that of simply purchasing a stock through your investing app. And the frictional costs like building maintenance, repairs, and transaction fees and taxes tend to be significantly greater as well. Furthermore, for most people, the acquisition of a real estate property would necessarily require a secured bank loan, and these loans incur interest on top of the capital, which may be in the low 1 to 2% range for variable rate loans right now, but it's still significantly higher than, say, not paying interest and simply investing in a stock. Obviously, this is a ridiculous comparison considering the types of investments that they are and the differences between them, but I'm simply using this to illustrate how real estate has a significantly higher frictional capital requirement than stock investing. Alright, now for number 2, illiquidity and lack of cash flows. So on top of the higher frictional costs of real estate, apartments, land, houses, buildings, and all that's encompassed by the real estate moniker are incredibly illiquid. It's significantly harder to sell real estate when there's no demand for it. Of course, the massive real estate bull run we've seen over the past half decade has everyone believing that this market will never reverse course, so there will always be buyers, but even if that's the case, it's much harder to get hard cash through the sale of an investment property in a timely manner than it is to do the same thing with the sale of common stocks. If I need to take out 10 grand to finance an emergency expense that exceeds my emergency savings, I can do that over the course of a few days with my stock portfolio. Conversely, I can't just fraction off my apartment and sell only 10 grand worth of it, and even if I wanted to sell the entire property, the advertising, transaction time, paperwork, and bureaucracy involved in the process could take a very long time when compared to liquidating a few positions. On top of this, real estate illiquidity can lead to a few cognitive errors like believing that the value of a property is reflective of the wealth of the owner. Like, having a house that's gone up 200 million won in value has made the owner 200 million won richer. While this may be true in terms of equity, to actually realize the true value of the property, the owner would necessarily have to sell it or take out a HELOC, which simply just leverages the property's value and makes your financial situation more precarious and a little more dangerous than before in the case that anything goes bad at any point. Now, while this remains true for stocks as well, stockholders can more quickly realize their equity growth through the click of a button, or they could just sell out as much as they put in initially and let the interest ride. In any case, it is much easier to buy and sell a stock than it is to buy and sell an apartment, house, or land, and that can actually come through if you really need the cash really urgently. Finally, 3. Work. I actually think I covered 3 over the course of 1 and 2, but generally speaking, properties require work to acquire, work to maintain, and work to sell. If something breaks, it takes capital or work to fix it. Before selling the property, it takes work to ensure that the property is in attractive condition. Of course, you could always pay someone to take over that work, but that would cost extra capital, which, again, frictional costs. It may not be worth it. But in the grand scheme of things, the work it takes to research, understand, purchase, or sell a stock is not non-existent, though it is definitely fractional when compared to the work that goes into real estate investing. I mean, assuming that you're doing both right. Because the entire premise of this episode that pits stock investing against real estate investing assumes that one knows how to identify and evaluate stocks and ensure that they're buying into good companies that would beat the returns of the real estate market. Investing is work, but it's work that gets easier over time and can be repeated ad infinitum over the course of your life due to the nature of the asset type. For most regular people who are unfamiliar with stocks, real estate investing may seem much easier since the asset is tangible and functional, and the purchase and the sale process is, if not transparent, at least pretty translucent, like you know somebody who's done it. Comparatively, stocks are similar to pari-mutuel bets. If you find a situation where the market is inefficient, putting odds heavily in your favor, all you have to do is put the money in and wait for the market to catch up. But one big problem for a lot of people is that it feels too close to gambling, when in reality, even real estate investing is pretty much the same thing, and it leverages you, so it's pretty much the same thing anyway. On top of these 3 sticking points, for me there are a few other things that make real estate investing less attractive, like an inability to diversify, high initial costs, and lack of guarantee for price appreciation. Again, the last one applies to stocks as well, but it's easier to stomach when considering the former 2 points. Now don't get me wrong, real estate does have advantages over stocks, many of which are good arguments for real estate investing, and I would personally argue that for my friend's coworker, it was a much better alternative. The biggest one of those being that it housed her family. Some returns are significantly more valuable than cash returns. The coworker in question has a family, and previous to buying this house, they'd been in a Junsei situation which was generally not entirely terrible, but the biggest problem with Junsei when you have a family is that the owner of the place that you're renting could choose to refuse you a successive contract, meaning that you're always at risk of having to move houses every few years for reasons entirely out of your control. Hiring movers to transport appliances, furniture, and other basic items every 2 or 3 years can get costly, and there's also the issue of having to relocate your children to schools and break their routines, which for many parents is something to avoid. With no guarantee that you'll find another rental in your area within your price range, there's a certain security that comes with owning your own place that you simply cannot get in a rental situation. For families, security is really important, and owning a house that conveniently doubles as a financial asset can be way more valuable than a stock could ever be. Personally, my partner and I don't have kids, and we don't mind finding appliance-provided rentals every few years since she has an SUV that can move basic furniture and belongings, and I have a hatchback that can move all the leftovers. For us, the incentive of having a home at this point in our lives is not that important. Now, another thing that we have to consider about mortgages and real estate investing as a whole is that there are certain cases where illiquidity actually works out to one's benefit. For example, paper-handed investors might not be able to deal with seeing an asset down 3%, or 15%, or 20%, or even 50% for a few weeks, even if they believe in their thesis and nothing has happened to affect the value of the company in real life. In that case, said investor may panic sell for a loss instead of buying more during the dip. Conversely, the inability to do so with real estate could prove beneficial since real estate volatility is by no means being flashed in their faces via app on a daily or weekly basis. Now, to summarize the conclusion that my friend and I came to, it's basically the same thing that we came into this episode talking about. The suitability of any investment vehicle always comes down to the values, goals, and needs of the investor. Real estate may be far more suitable for the average person who doesn't know much about investing and doesn't aim to know more than they already do. It may be more suitable for those who would use the asset as a place in which to live and build memories with their family. It may be more suitable for someone who knows the ins and outs of the industry. Personally, I know that's not preferable to me, and I'm comfortable with that. Alright, that's it for me today. I hope you found this video helpful in any way, and if you have any arguments for or against what I've been saying, feel free to leave us a comment below and tell us how wrong we are. Hope y'all are having a good week, hope you got a good rest on Wednesday, and we'll catch you in a minute. Peace.